what we do is not trying to go for the home run, right? It's like don't take crazy risks. Like, let's look for singles. I mean, we're trying to get an 8 to 11% net return for our LPs in an unlevered senior debt position on real estate that people know and understand.
Hey, this is Josh Flade, and I'm with my co-host Paisley Nardini. This is a Building Better Portfolios episode number 7. I'm with Mike Nixon and Andrew Peterson from Sundance Bay. And so let's first start out with, Mike and Andrew. Why don't you tell us a little bit about yourselves? Why don't you tell us something that's maybe something that most people don't know about you, so we can get to know you a little bit better, and then tell us a little bit about your firm.
Okay, great. I'll take the lead. So I'm Mike Nixon, and something that most people don't know about me. I'm a pretty open book. I speak fluent Russian and Ukrainian, which is kind of odd. It's not something that I put a lot of day-to-day use into. I wish I spoke Spanish, actually. I think that'd be a lot more useful.
Yeah, can we just do the whole podcast on this, actually? Scrap our agenda.
We can go really deep there. Should I admit that I took my 10-year-old son into Ukraine post-war? That's where we could really go with the podcast, but as a negligent father. No, I mean, I definitely have a love and appreciation for that area of the world. I spent a couple of formative years there, and hence how that's kind of helped define a little bit of who I am. The language isn't as useful. We don't use it, in our business, but it certainly taught me a lot of life experiences being over there and going through that, right? I'm from College Station, Texas originally. My dad taught Texas A&M University. I came out and did my schooling here in Utah, then went back to Texas, lived in Boston. I did an MBA at MIT. So kind of got a little grad school exposure, worked with McKinsey & Company for a few years. And I kind of cut my teeth originally in real estate, moved into more engineering and construction capital projects, and then kind of ended up shifting into Sundance Bay, which is a vertically integrated real estate investment firm. So we do, kind of multifamily and debt, and we talk about that in a little bit, but kind of in a roundabout way, made my way back into the business. And so that's kind of me in a nutshell.
Nice. Peterson, let's see. Something that most don't know about me is most people go to state for like football or basketball or hockey or something like that. I went to state for auto mechanics back in the day. Something a little bit different.
Did you get a Letterman's jacket with that?
Yeah, I should have. Yeah.
I like you guys. Very unique backgrounds.
They come out. So it kind of is the way that people around here know I'm like pretty mechanically minded. It's just the way it was. I grew up in a construction family, so my family was, home builders. And so kind of always, I can just see how things go together. Originally from Utah, went to the University of Utah, kind of cut my teeth in finance at a bank here called Sundance Bank. They're kind of the larger regional operator here in their construction real estate department. Did that for almost 10 years. And then I went back to New York and went to grad school back there at Columbia. I thought I would never look back. I was like, I'm going to go to New York. I'm going to live it big. I'm going to do it out there. Worked out there for a couple of years. Hopefully, no big New Yorkers that will hold me to this, but it just did not work for me. It's just a really tough market. New York is, and to cut your teeth, and where I was in my career. So after working there for a little while, met the team at Sundance. I've been here now for a little over 7 years, and it's been great. So been a really fun ride here and a lot of growth, and work very closely here with Mike.
Well, we're so glad to have both of you here with us. Who's the typical other side of this kind of transaction, this lending transaction?
That's easy. I'll take who the borrowers are, and then Mike can maybe, take a little bit on who the actual investors are.
I think maybe just kind of why does this even exist? I mean, a big part of this, honestly, was 2008. I mean, Andrew and I both kind of were in real estate, had exposure in 2008. I had raised money from private investors, put them into deals, kind of at the early stage of my career when that pro forma made sense. You put assumptions up there. Oh, great, you're going to get this return. And it had always gone up, right? This is kind of mid 2000s. Until obviously it didn't, right? And that's where real estate really got hurt. We've got some scars to show some how projects didn't succeed during that market. And so I think coming out of that, we knew there was a need for private debt. We settled on unlevered private debt. We felt like that was a good spot to play and kind of pick up where banks had left off. And even though we were coming at it from different perspectives, I think we both felt, that, where the market kind of failed everybody else during that time. And we went out a vehicle that we thought could last. And candidly, I didn't want to have to go back to investors again and say, I've lost money, right? So how do you build something that you think, can weather a storm like the 2008 crisis? And some other partners here at our firm had kind of hadn't put a lot of structure to it. And kind of what we've done here is really scale that, right? So what started out as a couple $1 million, friends and family money, rolled up to 5 million to 10 million, and now we're over $900 million in a vehicle where we're doing short-term construction debt. So it's been quite the journey, right? To see that take foot and the type of borrowers that we work with, the investors, a lot of wealth management, institutional type investors, family offices. Anyone who likes unlevered debt, it's asset backed. That bodes pretty well.
I have a quick macro question, actually, just before we get into more of the investors. Thinking about post GFC, a lot of the banks, from a regulatory perspective, the lending standards were obviously cracked down on. And so this private credit and private lending type space is really blown up. And so at some point in our conversation today, thinking about why that's a tailwind, of course, for your organization, and then more importantly, thinking about that environment post-COVID. And I know we'll get to that, just that macro tailwind of needing sources of lending that are outside the traditional bank space.
Yeah, there's a ton. I was in banking during that time, the GFC, and that's where I kind of started my career. So I got to see the best of times to the worst of times to better times in banking. But definitely Basel and all of that the regulators put on to banks, it just makes it extremely difficult for them to lend, and it continues to be difficult for them to lend. So it really opens up a space for us. And then, one thing I did notice during my time in banking during the GFC was how quickly banks had to unload assets. They couldn't hold them on their balance sheet. Their reserves were tremendous. If there is a problem, we don't have to take a haircut. We can work through the issue. We can hold out. We can maximize profits. Where I saw that in the banking world, had they just been able to hold on to assets for another year or two, they would have came out without a loss. But they didn't. They had to unload them. It was a lot. The OCC and the feds really pushed them to do it. Even though in the media, the Fed said, oh no, we're not doing this to the banks. Well, they really actually were. And I saw that. And so, they have continued to just be really hard on banks and the regulatory side of it. And so I see the private credit side just continuing to grow. It's interesting. The way that the regulations are set up currently is banks are actually, it's better for them to actually lend to private lenders and let them actually lend directly to the asset base, the borrowers. And it's, especially in the real estate side, it's a different type of credit than CRE. It's actually more C&I. And so it actually helps out for those like that because it gives us flexibility, especially because we do so much construction, which we find is a great niche to find a risk-adjusted yield in the market.
And maybe a quick little story. So, back in 2007, we did a deal. It was supposed to be a 90-day deal, right? It was on kind of raw land that would eventually be developed. It was kind of where the future housing in Utah was taking foot, quite a ways outside the major population areas. But there was interest. Builders were interested in going out there. We felt good about the ability to flip it, make some good money on it, and did this 90-day deal. Lo and behold, 2007 comes. The market, one buyer falls out, we keep the earnest money. Second buyer comes in, he falls out, we keep the earnest money. But then basically no buyers were at the table. And then you got to 08, 09, and nobody would touch real estate with a 10-foot pole, right? And so we're left holding this asset. We had to do capital calls from our investors. We had to kind of sit on it, basically restructure it and sit on it for what ended up being 10 years. And a lot of that's because we had to put more capital into it. So it's kind of it's those experiences, right? When you've lived through that and you've worked nights and weekends, there's no upside for us as managing that capital. It was more about how do we just get our investors back their money? That kind of led us into saying, we could do a strategy where we are the debt and we don't have to do a capital call. We can sit on this and use time to kind of heal those wounds. Let's do that. And that's worked really well for us.
What are the typical terms of your loans? So I know you're kind of your ideal borrower. It sounds like construction loans. For our listeners, like what are the typical terms and kind of what are the yields on those loans?
I mean, shorter term debt is what we really focus on in the construction. We really like the portfolio to turn. And so usually anywhere from 18 to 24 months, sometimes as short as 9 months, just depending on what kind of deal it is. We do a lot of finance for residential subdivision, like ground up development where they're selling off homes. Those obviously are shorter. They're just rolling. It's just a constant roll. We've seen, talking over the last 3 years, we talked about that earlier. We've actually seen a good amount of payoffs and churn in that portfolio, in the single family residential portfolio. So we really like that. That represents anywhere from 40 to 50% of our portfolio, but those will be shorter term loans and it'll just churn and churn and churn. Some of our commercial stuff's a little bit longer. Our rates vary anywhere from, 9, 10, 11, 12%, depending on the risk. And, a couple points in is kind of what we're doing. And borrowers are willing to pay that for ease. I'll give a story about that. We have a borrower in the Inland Empire, which I never thought that we would really lend in that market. That market's a really tight market. If you know that, Southern California, it's the hub of distribution. Like everything goes in through there. And we have a borrower down there and definitely bankable, massive balance sheet. And I was talking to him, I was like, why do you continue to use this? I'm not going to lie, like you're easily bankable. And he said, Andrew, life's too short, the ease of use, how straightforward you are working with you. He said, I'm willing to easily pay $500,000 or more in interest just for that certainty of execution. And that's really what we try to bring to our borrowers that banks, unfortunately don't. And I was in that world and it was so frustrating to give that to your borrowers. You're like, well, we can maybe do the loan, maybe not. We'll let you know. And these developers I just need certainty of execution and we'll pay for that. And so that's
very much a relationship business on your
60% of our borrowers are return borrowers. We're very much in the relationship business. We don't typically win on pricing. We lend on service we win on service and relationship. That's kind of what we do.
So can we, Josh, I'm sure you're going to go there at some point, but just thinking about the rate environment and the impact that has, I mean, it's all relative, right? It's not like your guys' rates are 10% and banks are lending at 2%. That's no longer the case, right? Yeah. So the whole curve shifted across industries and such, but what of those forces, what are the forces that those have had on your business as rates have backed up?
Yeah, I mean, I would say that, it's interesting. We look at the portfolio from kind of rate spike, right? And the Fed adjustments to now. And the rates haven't varied a ton, right? I mean, at the end of the day, it's kind of short-term debt. And so in the same way that we didn't necessarily get the benefit of the rate jump as it went forward, we're not expecting a big pullback as rates start to drop. The biggest impact has been on the traditional banking system and the ability because you do want a healthy system. Just because we compete against banks on short-term debt doesn't mean that we don't want banks in the system. We need someone else to go do that 30-year mortgage, 15-year if it's commercial. Yeah. We need that type of cheap debt around because our model works if we're just churning through, shorter-term debt. And that's why our borrowers can afford it too. They're not locking up, a rate that's 3 or 4% higher than a bank for 30 years. They're doing that for 18 months. And so I think that what we're really anxious to see, and we're already starting to see this, is that candidly, between a boom in private credit, a lot of funds have been raised, and there's almost like a race to the bottom right now on yield for a lot of those bridge funds. They're competing hard against each other for good deal flow. They're getting really competitive on rates, and then banks coming back in are two ways where we get liquidity for loans that we've already issued. When they get built, they get constructed, they get leased up, those groups come in and take us out. So as the rates get lower, it's going to make it easier for that type of commercial debt to turn over.
I agree.
Does that make sense?
Yeah, absolutely. Yeah. I think that's super helpful. And then irrespective of the rates, because like you said, because they're shorter term in nature, because there wasn't this direct movement with like the Fed, adjusting interest rates at the front end. In regards to just overall construction activity, I would kind of assume you guys are a bit at the front lines to kind of see when activity is picking up or when it's slowing down, knowing that you guys are more honed in on that Sunbelt region. So maybe there's geographical differences, but like what's the barometer right now on construction activity? Like, what are you guys seeing?
That's interesting. I mean, we're still seeing a decent amount of requests. We're seeing it pick up a little bit more, especially with the Fed's fund rate going down. Yeah. Now that doesn't necessarily mean, like Mike was saying, the long-term rates are going down. Obviously, as you guys know, it's tied to the 10-year, but today, I don't know where the 10-year is, but yesterday it was touching 4. And so that kind of gives developers and our borrower hope. It makes them excited to go out and do new projects. And as they start to see the cost of capital go down, they're going to be more excited to do new projects. Also, one thing that we're seeing right now is a lot of developers are trying to get in because you've seen construction costs ease off. We've seen anywhere from 8 to 10% in the market come down. And so a lot of people want to take advantage of that while they can, because they know that if the 10-year treasury drops down to 350, you're going to start to see a lot more activity in the market. And immediately that 8 to 10% savings is going to go away very quickly. It's just going to vanish. And so there's a lot of people that are trying to get in ahead of that and take advantage of that. And they're taking risk on to do that, because right now the yield there on the profit side for them, it's not as high as it could be. But they're like, we're gonna take a little bit more risk right now, knowing that we can lock in lower construction costs. And then hopefully, I'm talking on like commercial buildings, like, apartments, industrial and stuff like that. They're hoping in 18 to 24 months that, there'll be even lower interest rates. One other thing that our developers are also bullish on, and the reason why they're starting, is there hasn't been a lot of in the commercial world. So when the market really does turn on and you start to see institutional capital come in to purchase assets, not going to be a lot for them to buy. And so a lot of our developers are like, we're going to get ahead of this. We're going to be completing, hopefully as kind of the market stabilizes, and then it's going to be a feeding frenzy for these deals. And we're going to be able to get a lower than market cap, because we're going to have some of the only product online to be able to sell.
Yeah, and I think that's where we had to pivot a little bit is, if you think about it, over the last few years, there's been less demand for commercial construction. A lot of those projects just haven't penciled the same way. We still get developers who would come to us, but very few of those projects actually made sense, right? The value just changed. And so the construction costs haven't come down enough for that to really pencil for us. And so we did a lot more on the for sale residential side, especially with entry-level homes, where there's still, a 10-year undersupply of housing, the Mountain West, Sun Belt. And so we really kind of pivot the portfolio, focus more on the sectors that were performing. And now we're encouraged because we're seeing the tailwinds coming back to commercial real estate, so we can kind of adjust back to that opportunity.
We really do like to keep like a diversified portfolio where you have a little bit of commercial, which is industrial, hospitality, retail. We don't have any office in the portfolio, and then a multifamily, and then we have our for sale residential side of things. So it's like you kind of get spread across.
There's never a boring day. You're always underwriting something, right? Something out there can make sense. And then, it's a matter of taking 100 deals that come through our various relationships and pipeline, and then finding the one or two, candidly, that we're willing to fund. And that's kind of what we focus on day to day.
So we've clearly gone through kind of a down cycle in commercial real estate, right? And I think we're starting to see, and consistent with what you just said, we're starting to see these green shoots come up.
No.
Walk us through, because like you said, you have these developers, the math pencils, and then suddenly you have inflation, you have higher interest rates, the math doesn't necessarily pencil anymore, but you guys are underwriting these deals. How do you handle that situation when you like the math no longer pencils for the developer, and you end up maybe having to take over the project or take over this. You're lending to them, so you'll just take it over and they turn the keys over to you. Walk us through kind of what that looks like.
We really try not to take over assets where we don't have to. I mean, I think what we've done out of the
8 out of 470, something like that.
We're really not trying to do that. Now, we have a great asset management team. We have people that specialize in construction. We have people that specialize in leasing. We have a multifamily equity vertical that, understands property management and all that. So we're prepared to be operators if we need to in deals, but we're really trying, that's not our business plan. Our business plan is to go out, make good loans, have the loans pay back, and then move on and keep recycling it. We do look at it from an equity lens because you just never know what happens. Like when we underwrite deals, we're like, how does this look if we have to take it over at this basis? Are we comfortable with that? Yes, we're gonna look at that, but
that's our 2008 paranoia we always have with us, right? It's like, oh man, if we go back there again, what's this going to look like? Like it's got to meet that bar. Otherwise, let's not do it just because we lived it and experienced it.
Yeah. So we really look at that really closely on that. And so, right now what we're seeing is, our debt yield is we've definitely increased that. Our leverage has come down compared to where it was years ago. And so we're just kind of creating a bigger buffer on the loans that we do. And then from the developer side, on their side, sure, their costs and their yield are pretty low based on our underwriting because we're more conservative on the underwriting. However, developers, they're just optimists by nature. And usually if you look at their underwriting, they're going to make, $5, $10, $20 million on that. And so they're kind of like ready to go, regardless on that. But we'll look at it from our vantage point. So right now, basically any asset we're lending on, we're like, the leverage is enough that if we did end up with it, we're going to be in an okay spot.
And I'll say this because we're kind of a unique animal. I mean, we're talking to you today from like the debt perspective, right? Yeah. And that's what we run. So we live in day to day, but we totally have exposure to the equity side. So like, half the AUM of the shop is on the equity side of the business in real estate. And so we're absolutely watching those trends. We try not to drink the Kool-Aid like maybe some developers do and assume that it's just, there's no risk, all reward. I mean, that wouldn't be realistic. But what is encouraging is that you're finally starting to see rents, that are starting to kind of bump up, right? Or at least you anticipate, man, all that vacancy has now been eaten up in the marketplace. So we have the ability to bump rents. And that's what's really killed, say, multifamily over the last few years, is that you had a ton of supply flood the market. And then, because inflation had just taken rents so high, people couldn't afford to live in those places. And so you didn't get the rent bumps you had pro forma. So it's taken a while for the market to absorb that. But definitely the stuff we're underwriting today, you're able to kind of put in, relatively modest, but 2 to 3% annual bumps. And the market is starting to deliver on that. So there are some encouraging signs.
That's awesome. And you talk about leverage, Andrew, and I'm making an assumption here. In the underwriting, what kind of loan to value are you looking at? How do you look at that to ensure that you have enough just buffer in case you hit a worst case scenario?
Yeah, totally. So right now, kind of the max loan to value that we'll do is, 70%. And that's based on market cap rates, which over the last 3 years have expanded. So for example, multifamily deal in San Diego, it used to trade at a 4. Now it trades at a 5. So we're using that 5. So we're moving with that. So we're at 70% of that. So our debt yield would be like a 7.5, for example, on that. So we've got 150 bips of spread in there, a buffer. And so that's kind of where it is. And so that's where we've kind of stayed.
So think like, probably 60 to like maybe 70%, 72% loan to value. I mean, that's kind of where we're going to sit, right?
Yeah. On adjusted values have over the last 3 years come down tremendously. So even if they stay flat, we, again, as Mike mentioned, we don't expect there to be valuations. I mean, if you listen to like Blackstone, they think the bottom's come in. Like we're kind of in the bottom of where we're sitting, that according to them. And so,
what do you think?
That's what we're using. We're using a conservative bottom valuation, being very conservative on rent assumptions, cap rate, compression. And so that's kind of where we'll sit on that.
I mean, I tell people all the time, like, what we do is not trying to go for the home run, right? It's like, don't take crazy risks. Like, let's look for singles. I mean, we're trying to get an 8 to 11% net return for our LPs in an unlevered senior debt position on real estate that people know and understand. Not on water parks. My kids would be thrilled if we did water parks, right? We don't touch that stuff. We don't do the special.
Call me if you start investing in water parks. I'm in.
And we got some really cool parties or something. People, we'd be everybody's best friend if we had those assets. But we like kind of the bread and butter housing, industrial warehouse, and the pre-lease credit tenant, kind of net lease type stuff. And if you're in that space, then you're pretty well protected. And that's where our portfolio is kind of able to do quite well, even in times of headwinds in the real estate markets.
What I love is like the idea of this margin of error. Like for those who are listening who maybe aren't as familiar with this, that loan to value. So if your loan to value is 70%, that means there's 30% that could fluctuate. Right. And if you had to take over the project, you would still be made whole as some.
I love it. Well, my takeaway, I think this area of the market has spooked a lot of individuals because of the headlines and post-COVID, and everybody's heard how horrible real estate is or has been. The more measured, kind of prudent approach, conservative approach that you guys are taking, the fact that these are shorter term loans in nature, all of that, I think, puts a refreshing take on this part of the market. So I'm really happy that we were able to have this conversation today. I think this might be really applicable for a lot of our listeners.
Great.
Absolutely. Well, hey, Mike, Andrew, Paisley, thank you all so much for being on here. And we'll that's a wrap.
Hey, thanks for having us.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.